Annual subsequent net cash flows. Annual net cash flows that take place after the project begins include annual after-tax net operating cash flows and cash outflows for follow-up investments, if any. After-tax net operating cash flows. The annual after-tax incremental net operating cash flows include two items: pre-tax incremental operating cash receipts net of related cash disbursements multiplied by 1 minus the tax rate. The depreciation tax shield, a cash inflow, explained below. After-tax net operating cash flow is equal to pre-tax operating cash receipts minus related cash disbursements multiplied by 1 minus tax rate plus depreciation tax shield. The depreciation tax shield is the tax depreciation for the period multiplied by the tax rate. After-tax incremental operating cash receipts net of related cash disbursements. When a company starts a project, it generates after-tax cash flows from its operations, which could either stay consistent or change yearly. These cash flows come from two main sources. Number 1, increased sales. If the project works well, sales increase, resulting in extra cash inflows, money received minus expenses. However, in the early years, while sales are building up, cash inflows might be negative, meaning the project could temporarily lose money. Number 2, decreased operating costs. Efficiency improvements can reduce operating costs, creating savings. These savings count as cash inflows. Impact of taxes. The company pays taxes on increased profits from higher sales or lower costs. To find after-tax cash flow, multiply the pre-tax amount by 1 minus tax rate. After-tax cash flow is equal to pre-tax cash flow multiplied by 1 minus tax rate. Taxes reduce both cash inflows and outflows. Depreciation. Depreciation, a non-cash expense, doesn't directly affect cash flow. However, it lowers taxable income, reducing the tax paid. This tax reduction, called the depreciation tax shield, adds to cash inflows. In short, cash flows depend on sales growth, cost savings, and taxes. Depreciation indirectly helps by reducing taxes, boosting cash inflows. Depreciation tax shield, an operating cash inflow. The depreciation tax shield is the tax savings a company gets because depreciation reduces taxable income. Depreciation is an expense that reduces taxable income on the company's tax return. This lowers the taxes the company owes, creating a tax benefit. Depreciation tax shield. The tax savings from depreciation are called the depreciation tax shield. It's not actual cash received but reduces the cash paid for taxes, so it's treated as a cash inflow. Formula: depreciation tax shield is equal to depreciation expense multiplied by tax rate. Methods to calculate depreciation. MACRS, Modified Accelerated Cost Recovery System. Common in the US, it uses varying rates depending on the asset's life. The annual depreciation is equal to full asset cost multiplied by MACRS rate, provided in problems. Straight line depreciation. Annual depreciation is equal to full asset cost divided by useful life years. Key rule. Depreciation uses the full cost of the asset, ignoring salvage value. The asset's full cost includes purchase, shipping, installation, testing, and setup. Depreciation tax shield is equal to full cost of asset multiplied by annual depreciation rate multiplied by tax rate. If a new asset replaces an old one that's still usable and not fully depreciated, use the difference between the new asset's depreciation and the old asset's depreciation to calculate the depreciation tax shield. This difference may change over time, especially if the old asset's depreciation ends before the new asset's life does. Cash outflows for follow-up investments. After the initial investment, the company may face additional cash outflows during the project's life. These can come from: Number 1. Additional capital investment. What it is: extra money spent to maintain or buy new equipment later. How it's treated: the amount spent is recorded as a cash outflow. Starting from the year of the investment, the company gets a tax benefit, depreciation tax shield, on this new investment, which is an inflow. Number 2. Increased working capital. What it is: more funds might be needed to support business operations, for example due to higher sales. How it's treated: treated like the original working capital investment, a cash outflow with no tax effects. Important notes. Number 1. Tax effects. Additional capital investments affect taxes through depreciation, depreciation tax shield. Increases in working capital have no tax effects. Number 2. No financing costs included. Interest or other financing costs are not included when calculating cash outflows for the project. Cash flows at the disposal or completion of the project. The termination of a project creates several potential cash flows. In the final year of a project, there are usually two main cash inflows. Number 1. Sale of assets, salvage value. The company sells project-related assets, for example, equipment, property. Tax effects. Calculate gain or loss. Gain or loss is equal to sale price minus tax basis, book value. If fully depreciated, tax basis is equal to $0. The entire sale price is a taxable gain. Tax on gain. Tax is equal to gain multiplied by tax rate. Net cash inflow. Sale price minus tax on gain. For a loss, the tax benefit is tax savings is equal to loss multiplied by tax rate. Add this savings to the sale price for the net inflow. Number 2. Recovery of working capital. The initial working capital investment, for example inventory, receivables, is recovered at the project's end. There are no tax effects on recovered working capital. The amount recovered is the same as the amount invested, unless stated otherwise. Final year cash flows. Look for asset sale with tax effects for gain or loss. Working capital recovery, no tax effects. Other possible cash flows. There might be after-tax operating cash flows or depreciation tax shields, depending on what the question specifies. If assets are fully depreciated, there will be no depreciation tax shield. Key point: only the asset sale generates tax effects. Working capital recovery is a tax-free inflow.